In this section, we will discuss service release premiums as well as encumbrances and liens. When loans are created in the primary market and sold into the secondary market, they are either sold at a discount, at par, or at a premium. A discounted sale creates a loss to the lender who made the loan because he or she does not get back all the money he or she loaned out. Par is when the lender gets exactly what he or she loaned out back. And a premium sale generates a profit to the lender and gives him or her more money than he or she loans out. That premium is called service release premium, and here's how it works. Interest rates change routinely throughout the day based on market conditions. Regardless if interest rates are going up or down, there is always a par rate. This is the rate that the market is paying 100 cents on the dollar to purchase. Interest rates below that rate are considered discounted rates because they trade at a discount to par. For example, 97 cents on the dollar. Rates trading above par are considered to be trading at a premium. For example, 103 cents on the dollar. When mortgage lenders sell their loan into the secondary market, the price they get for the loan depends on the interest rate relative to the market on the day they sell it. Any price they get above par is considered premium because the price reflects the premium paid for the spread in rates. Lenders who sell loans in the secondary market receive the service release premium for releasing the servicing rights to the new lender and therefore releasing all future interest income from the loan to the new lender. Sometimes, however, large banks and lenders sell their loans to the GSEs who do not service loans. In this case, these lenders and banks still receive an SRP, but may also be asked by the GSE, such as Fannie Mae, to service the loan for them, making Fannie Mae the investor and the bank the servicer. Now that we have a better grasp of SRPs, I'm going to talk about encumbrances and liens. These are legal terms that are important for mortgage loan originators to understand. First, an encumbrance is a claim against property held by one who is not the legal owner of the property. Encumbrances can be either physical or financial. Physical encumbrances affect the physical condition of the property. They may be imposed on a parcel of land, but do not prevent the owner from using, selling, or otherwise transferring the estate. Some examples of physical encumbrances include easements, public and private restrictions, as well as encroachments. An easement is a right granted to a person or entity to use someone else's property for a specific purpose. For example, a utility company may have an easement to run power lines across your property. Public restrictions are imposed by government agencies such as zoning laws. Private restrictions are imposed by the owner of a property such as a homeowners association. And finally, an encroachment is when one property intrudes on another property. For example, if your neighbor's fence is on your property, that is an encroachment. On the other hand, financial encumbrances are debts that are secured by the property. The most common type of financial encumbrance is a mortgage. A mortgage is a loan that is secured by your home. If you default on your mortgage, the lender can foreclose on your home and take ownership of it. All right, let's move on to liens. A lien is a legal right or interest of a creditor in the property of another. Liens can be either voluntary or involuntary. Voluntary liens are created when a property owner voluntarily agrees to give a creditor a lien on their property. The most common type of voluntary lien is a mortgage. Involuntary liens are created when a creditor is granted a lien by a court. The most common type of involuntary liens are mechanics liens and judgment liens. There are many different types of liens, but some of the most common include mortgage liens, mechanic liens, and judgment liens. Mortgage liens are liens that are created when a property owner takes out a mortgage loan. Mechanics liens are liens that are created when a contractor or subcontractor is not paid for the work on a property. And judgment liens are liens that are created when a creditor wins a lawsuit against a debtor. Furthermore, there are two types of liens, general liens and specific liens. General liens apply to all of a debtor's property, while specific liens apply to only one specific piece of property. Tax liens are a general lien. This means that a tax lien will take priority over any other lien on a property, including a mortgage. This is because the government has a strong interest in collecting taxes, and it wants to make sure that that is paid first. If you are considering buying a property with a tax lien, you should be aware of the potential risks. The tax lien could prevent you from getting a mortgage, and it could also make it more difficult to sell the property in the future. Finally, a lender's rights with a specific lien are typically superior to the rights of any creditors that would file liens against the subject property at a later time. There are some exceptions to this, however. Most notably, specific liens imposed by state, local, or federal government for non-payment of taxes will supersede all other liens. Otherwise, when it comes to specific liens, the doctrine applied is first in time, first in line, meaning that lenders establish a priority position on the date their loan document is recorded. Therefore, lenders that have the earliest recorded lien are considered first, and their rights take priority over subsequent lien holders. I hope this video has helped you understand encumbrances and liens a little better. We will now move on to discuss the note and the deed of trust.